what do you think about this what's been going on with interest rates and, just the massive shoot up in interest rates, and how does that change your strategy, if it does change your strategy at all, in particular with regards to owning cash and bonds compared to stocks?
I think it doesn't change my strategy because my strategy is based on the next 20, 30 years. And I know that on the long term, it's better to own businesses. And the cash I have is always there for opportunities. So I hope to deploy it so I don't really take it too much into consideration. But interest rates are now at 5%, I think, in the US, a little bit lower in Europe, but it's still stimulative, because if you have inflation at 8% or 6% or something like that, inflation is still above interest rates. So you can say that it's still a stimulative environment, because you can you have to spend your money, because if not, you are still losing it on inflation. So when interest rates get above inflation, that would make the trick, but nobody wants to do it. So they can push it higher as long as they are below inflation. And the market expects that inflation will go down. We will go back to the 2010s of 2% inflation, and that interest rates will go then again down to 2%, 1% or 0. That is what is priced in the market now. So the financial engineering, money printing, low interest rate environment still works. And if it works forever, great. We just, every banking issue that we have, we just print a billion or trillion here, and we solve everyone's problem. Nobody goes bankrupt ever. Even the Swiss did that with Credit Suisse. Every Swiss person gives 13,000 of printed Swiss francs, and that's the solution. For how long will that last? I don't know. We have had a peak of inflation now it's slowing down. I expect that we will have higher inflation for a decade or two, and that will then be the solution for the debts and everything. But if you have money, you better invest it in productive assets than to just watch the money.
So when you say high inflation, what do you think it may be at?
It doesn't matter. Even just 2 years, or what we had the last 2 years with inflation at 6-8% for 2 years, that's already huge. That means if you were saving money, you lost 15% of your purchasing power. 15% of your retirement fund purchasing power is gone. That's huge, but nobody thinks about it, because it's inflation, you don't feel it. You look at your million, it's still a million, okay, but that million can buy you just 850,000. You don't feel it, you don't grasp that concept. So if we have 2% or 3% this year, next year 2%, and then in 2025 6%, and 2026 7% inflation, that's already huge compared to the last 10 years.
So one of the best ways to go about things is just to own assets that produce things. Is that right?
That's it. And that's the only thing that worked over the last 100 years. Every currency lost 95% of its purchasing power. Currencies are made to lose value, because that's just an extra tax that you don't think about it. Oh yeah, 2% a year, you don't feel it, but the government gets 2-3% more income, tax, the debts are paid off easier and everything. So that's the system we live in. And the only thing that works as a protection is investing in productive assets. That can be a house that gives you shelter, or rent, which is productive. That can be businesses that hopefully grow and do better. So, and that's the only thing we can do. And then the next step is the price you pay gives you a better protection. If you buy something on the cheap, you're much better protected than paying high prices, high valuations. And then you watch the cycle, and then you're back to value investing that works forever, and that's it.